All right, if you're hunting for value plays in the industrial space, you are absolutely going to want to pay attention to this one. We're doing a deep dive due diligence explainer on Quanex Building Products, trading under the ticker NEX. We're going to look under the hood of a company that's currently navigating what might just be the most critical phase in its entire corporate history.
So the million-dollar question, literally, does massive scale actually equal massive profits? That's the tug-of-war Quanex is stuck in right now. You know how it goes? When a company rapidly expands its footprint, the market usually holds its breath, waiting to see if all that new top-line revenue will actually trickle down into higher margins.
To figure out if they're pulling it off, here is our roadmap for this explainer. We'll start with the business and M&A scale, move through financial health and operational risks, and then weigh the valuation metrics, insider moves, and finally, the forward outlook.
Let's kick things off with Section 1, the business and M&A scale. Let's look at what Quanex actually is today.
The whole foundation of what we're looking at today hinges on a massive strategic pivot. Back in August of 2024, Quanex drastically expanded its geographic footprint and market position by acquiring Tyman. This wasn't just a minor bolt-on, this was a complete step change in scale. We're talking about pushing their fiscal year 2025 net sales up by a staggering 44% to $1.84 billion. Basically overnight, they established themselves as a top-tier global supplier to window and door original equipment manufacturers.
And what's really fascinating here is how this move materially expanded their hardware and ceiling portfolios. They didn't just buy market share, they bought globally recognized powerhouse brands. We're talking Amesbury Truth, ERA, Schlegel, and Giese, sliding right in under the same umbrella as their legacy EdgeTech and Superspacer products. It completely cements their status as a massive, scaled niche leader.
Moving on to Section 2, financial health and earnings. So how is all this massive new scale translating to the bottom line? Let's check the ledger. On the surface, things look pretty solid. We are seeing consecutive earnings beats against Wall Street's expectations. In Q1 2026, they beat revenue estimates and reported an adjusted EPS loss of just 1 penny, which actually beat estimates by 80%. Then, rolling into Q2 2026, revenue hit $462.4 million and adjusted EPS came in at 25 cents. That's a very solid 19% beat over expectations. So they are definitively clearing the bar that analysts have set for them.
But that brings us to Section 3, operational risks and headwinds. Because as any good analyst knows, beating a lowered bar doesn't mean the track is completely clear of hurdles. We have to address the headwinds dragging on their profitability.
Right off the bat, we have to talk about the price tag of this growth. As of April 30, 2026, Quanex is carrying $715 million in total debt. That pushes their leverage ratio, specifically net debt to last 12 months adjusted EBITDA, up to 3.1x. Now, in a macro environment where the cost of capital is top of mind for everyone, that is a pretty substantial backpack to be carrying.
And then there's this number. While the top-line revenue looks fantastic, the trailing 12-month metrics show a glaring $257.2 million net loss. I know, it looks scary, but wait, it is crucial to understand the why here. This was largely an accounting anomaly. It was a massive non-cash goodwill impairment charge recorded back in the third quarter of 2025, directly tied to integrating the Tyman acquisition. We always have to separate non-cash paper hits from actual operating cash flow.
That being said, the actual cash flow and operating profitability are still feeling a real squeeze. Management has been super transparent about the current operational frictions. They're chewing through post-merger integration and restructuring costs, plus they've got this temporary operational hiccup at their Monterrey, Mexico facility that's been a real drag. Throw in some somewhat muted organic growth, around 2.3% in Q1 2026, and softer overall volumes, and you get lower operating leverage. Basically, the machine is way bigger now, but it's just not running at peak efficiency quite yet.
Which leads perfectly into Section 4, valuation metrics and sentiment. Given this intense tug-of-war between expanded scale and integration pain, what kind of price tag is the market putting on NYX?
Let's anchor to this metric. As of late July 2026, Quanex is trading at an enterprise value to EBITDA multiple of just 7.27. Think about that for a second. For a company that just massively expanded its global market share, this is a multiple that screams the market is heavily pricing in those integration risks and operational speed bumps we just went over. And that gap highlights the potential opportunity if management can actually execute. The current price is sitting around $18.60, but when you run the trailing and forward PE multiples, value models are estimating a fair price of $21.43. That suggests a potential 15.2% upside. The market is essentially crossing its arms and demanding proof that this newly supersized Quanex can operate efficiently before it awards any sort of higher premium. Okay, Section 5, Insider and Institutional Action. Let's see what the big money is doing while everyone else waits for that proof.
Honestly, the institutional ledger is a total battleground right now. On one hand, you've got Angelo Gordon jumping in with a massive new $31.6 million position and Nomura throwing in almost $13 million. But on the exact opposite side, Vanguard trimmed their exposure by nearly $15 million, and Millennium Management basically gutted their position, cutting almost 90%. So half the smart money is betting big on this integration succeeding, and the other half is actively taking chips off the table.
And we see the exact same conflict internally over the last 6 months. We've got bullish insider buying from directors like Bradley Hughes, who picked up 6,500 shares for about 99 grand. But that is contrasted sharply against major dumps from internal capital partners like Telios, who unloaded 200,000 shares for roughly $3.2 million. It's a real mixed bag of conviction.
Finally, Section 6, Forward Outlook and Forecasts. The crucial point now is, what exactly is management doing to steer this massive ship forward and unite this split sentiment?
Well, they are shaking up the leadership right where the friction is highest. In April 2026, Chad Collins stepped in as president of the Hardware Solutions segment, taking over for Bob Daniels, who's retiring after an incredible 35-year run. The CEO explicitly noted that Collins is tasked with leading through complex change. They are literally deploying new leadership to act as a fixer, untangling those post-acquisition knots and optimizing the new scale.
Looking ahead to the numbers, management played it a bit safe, lowering their FY26 revenue guidance slightly to a midpoint of $1.55 billion. So that's essentially flat against last year, as they take time to digest the acquisition. However, Wall Street consensus is already looking past this digestion period. They see the company smashing through the $2 billion revenue mark by 2027, with EPS forecasted to expand to over $2 a share.
Which leaves us with this final, provocative thought to take away from our explainer today. With integration costs seemingly peaking, a really low 7x valuation multiple, and a new leadership team in place specifically to navigate these operational frictions, has Quanex finally paid the toll for its massive expansion? Is the juice finally worth the squeeze? The next few quarters are going to definitively answer whether this massive new scale will finally transform into sustained, profitable efficiency. Keep your eyes on this one.